If you really stop and think about it, the foundation of our modern world, the food on our tables, the roads we use, all the infrastructure, it's all built and harvested with these massive, complex machines.
Exactly. They're these global industrial giants, absolutely vital, but we hardly ever look under the hood.
So today, we are going to open up the engine bay on a huge player in this market, CNH Industrial N.V, or just CNH.
Mhm.
They're a titan in agricultural and construction equipment, and, their strategic health impacts a lot more than just their investors.
That's a great way to put it. And for this deep dive, we've gone through a stack of your sources, really anchored by a detailed research report from Compasscope.
And we've paired that with the most recent operational data we could find, pulling directly from their Q3 2025 earnings call transcripts.
Right.
So our mission today is pretty simple. We want to cut through the complexity and give you that comprehensive, structured understanding of the company.
We're going to map out their core business, their strengths, and the very intense competitive landscape they're in.
And the specific risks that are hitting their bottom line right now. We'll cover the business structure, that big rivalry with John Deere, their growth strategy, and the execution risks.
And then we'll get into the essential operational updates that tell us exactly how their plans are playing out in the real world.
Okay, let's unpack this. Let's start with the basics, the foundational structure of CNH Industrial.
Sounds good.
CNH is, it's defined by its massive scale in designing, producing, and distributing heavy equipment. But its revenue structure is actually pretty specific.
It is. When you look at the segments, one is just clearly dominant, and that's agriculture.
Right. It's the engine.
It's the absolute engine. It drives a colossal, 74% their total sales?
74%. So everything else is just sort of supporting that core?
Exactly. This is where they make their money. We're talking about the high-value, high-margin machinery.
The big stuff. High-horsepower tractors, those massive combine harvesters.
Yep, the multi-million-dollar combines. And their main brands here are the ones you probably know, Case IH and New Holland Agriculture.
And it's not just about selling steel and iron anymore, right? It's really about silicon now. The source material highlights this push into precision agriculture solutions, which means integrating digital tools, sometimes even retrofitting older equipment with GPS kits and sensors. They need to keep that installed base modern.
And they need that recurring revenue stream that comes with it. Then you have the supporting acts. Construction makes up about 16% of sales.
So things like excavators, loaders, graders.
Yep. And then finally, financial services clocks in at about 10% of total sales.
That financial services segment, the captive finance arm, it often feels like just a dry detail, but it's actually incredibly strategic.
It's so strategic. If we connect this to the bigger picture, it acts as this dual mechanism to both secure sales and stabilize their revenue.
How does that work exactly?
Well, about 3/4 of their financing goes directly to the customer. So, retail financing and leasing to help close deals on equipment.
Okay, so it helps the farmer buy the tractor.
Exactly. And the other quarter is wholesale financing, which they provide to their global network of dealers. This lets the dealers carry inventory without massive upfront costs.
So it creates this virtuous loop. The retail financing keeps the customer captive, and the wholesale financing keeps the dealer network loyal and stocked.
You got it. And that combination, the ag dominance, the smaller construction arm, and that strategic finance segment, it gives CNH a degree of countercyclicality.
Meaning they have some built-in resilience for when ag commodity prices inevitably fall?
Right. Or when the construction market slows down. That stability is incredibly valuable.
Okay, here's where it gets really interesting for me. How CNH actually stacks up against its rivals. The Compasscope report suggests CNH holds a moderate competitive advantage. That's based on its established brands, its huge global dealer network, and that captive finance arm we just talked about.
A moderate advantage in a world where its main competitor, John Deere, operates with an immense advantage.
It's a whole different ballgame.
It really is. Deere Co. just plays on a different scale, especially North America, which is, the world's most profitable agricultural market.
And the numbers are just stark. In North America, Deere commands close to 60% market share in those key large ag categories.
Compared to CNH's, roughly 30%?
Exactly. But the source material says the real difference isn't just volume, it's technology.
Yes. This is the crucial point. Deere built its technology lead organically. They own their platform from the ground up.
Which translates directly to higher returns and, more importantly, better pricing power?
And CNH, on the other hand, is characterized as a fast follower. They often rely on acquisitions to plug their technology gaps.
So they buy the tech instead of building it.
Right, which can be faster in the short run, but it introduces a lot of risk. It means they spend time integrating all these different systems, while Deere is just selling one seamless proprietary tech ecosystem to the farmer.
That sounds like a long-term structural challenge. So does the construction segment, only 16% of sales, does that help or hurt their competitive position?
Oh, it definitely hurts. CNH's construction business is just subscale. It's uncompetitive when you put it up against market leaders like Caterpillar and Komatsu.
Because those guys are so focused.
So focused. They have massive global scale and manufacturing efficiency just for that one segment. This lack of scale means the construction business often just acts as a drag, diluting the high profitability from their agriculture segment.
But, despite the Deere shadow and that construction drag, CNH is still a huge force compared to other players, right?
Oh, absolutely. They fare much better than a company like AGCO, which is smaller and critically lacks that captive finance arm. And they're way ahead of Kubota, which focuses almost entirely on smaller, mid-sized machinery.
So the conclusion is what? CNH is the solid global number 2 in ag.
I think that's right. They're the clear number 2, benefiting from their heritage and scale. But that competitive advantage is just notably narrower than Deere's, and it's mostly because of that difference in technology strategy relying on M&A versus organic innovation.
So given that dynamic, CNH has a very focused growth strategy. It's about boosting revenue, sure, but really it's about boosting margins to try and close that gap with Deere.
Yes, and their primary focus areas are precision ag and the aftermarket. They are investing heavily, specifically to drive that higher margin revenue.
So this involves integrating all the technologies they've bought?
Not just into new machinery, but retrofitting that massive installed base of existing CNH equipment all over the world.
Yeah.
This turns existing customers into, recurring revenue streams.
That retrofit strategy seems really smart. It means a farmer doesn't have to buy a whole new machine just to get access to GPS or digital tracking.
Exactly. And on the aftermarket side, they're strengthening sales of parts, maintenance contracts, and digital services. All of that is inherently more stable and higher margin than selling volatile cyclical iron.
And what about market expansion?
They are strategically targeting high-growth, underserved regions. Think Eastern Europe, the Middle East, places where agricultural mechanization is still lower, so there's more potential.
But again, it all comes back to that contrast in strategy. CNH buys tech, Deere builds it.
And that's the fundamental divergence that will probably determine who wins the long game.
Okay, and then there's the construction segment. The plan there is just to stabilize margins.
Pretty much, through aggressive restructuring and cost optimization. But the source material is very transparent here. Management is keeping the door open for partnerships or even divestitures.
Which signals how hard it is to turn that business around when you're up against giants like Cat and Komatsu.
The whole plan, especially getting to their ambitious 2030 mid-cycle margin goals, it all relies on two things: successfully integrating those complex acquired technologies and maintaining incredibly strict operational discipline.
And that brings us directly to the obstacles, to the risks. CNH's risk profile is noted as elevated relative to peers, and for good reason. If you're tracking this company, you have to understand where things could break down.
First up is that acquisition integration risk we've been talking about. Relying on external tech means potential delays and maybe not getting the synergies you expected.
And then there is the elephant in the field, cyclical exposure. CNH is extremely vulnerable to global swings in commodity prices and farm income.
And we're seeing that vulnerability play out in real time. There's a severe cyclical downturn hitting the industry in fiscal year 2025, and it's being amplified by all these other global economic factors.
There are also major internal cost pressures, right? Particularly tariff headwinds.
Yes, on inputs like steel and aluminum, which just hammer their margins. Plus, expanding into volatile geographies like Eastern Europe and South America naturally increases your exposure to political instability and, crucially, currency fluctuations.
So this raises that important question of internal discipline. You have the persistent construction underperformance diluting profits.
And even management continuity is listed as a risk factor. With the uncertainty around strategic execution after Jarrett Marks was appointed CEO in 2024.
That's a lot to juggle. Can the new leadership handle integrating tech, cutting construction costs, and managing geopolitical risk all at the same time?
It's a huge ask, And while CNH's diversified portfolio ag, construction finance, does mitigate some risk compared to Deere's heavy North American focus,
Yeah.
that reliance on acquisitions and the weak construction business, those are big internal hurdles they have not fixed yet.
Okay, now let's see how these risks are playing out in real time. Let's dive into the operational data from that Q3 2025 earnings call.
Right. The results were a mixed bag. They really reflect a difficult market. Consolidated revenues were down 5% overall.
And agriculture sales, that big 74% engine.
That was down 11%.
Wow. And the margin story here is so crucial. That 11% decline was driven by a sharp 29% decrease in the North American market.
Which is their highest margin region. Weak retail demand forced dealers to just clear out inventory.
But interestingly, they had some volume bright spots in EMEA. That's Europe, the Middle East, and Africa, where sales were actually up 16%.
Yeah, showing growth in places like Eastern Europe and Germany.
But wait a minute. If sales volume is up in EMEA, why isn't that just good news?
Because of the mix shift. As the CFO noted on the call, EMEA profitability is significantly weaker than North America's.
Ah, so they're selling more of their less profitable items and fewer of their high-margin ones.
Exactly. The volume is good, but it puts immediate downward pressure on the company's overall margins.
Let's talk about the tariffs, because the financial impact detailed in that earnings call is just staggering.
It's huge. Management confirmed tariffs are the major near-term drag. Q3 results showed a delayed impact of $45 million in unfavorable product costs.
It's just in the ag segment.
In ag alone, but that's just a quarterly snapshot. The annualized gross run rate impact is estimated at $250 million for agriculture.
$250 million. That translates to a full 200 basis point margin headwind.
It does. And for the smaller construction segment, it's about $125 million, which is a massive 425 basis point drag on those margins.
That is just an enormous hurdle to overcome through internal efficiency. So they're basically absorbing some of this cost right now.
They are, intentionally. They're working with suppliers and farmers, but their long-term goal is clearly to offset every penny of that through strategic sourcing and eventually future pricing.
Okay, what about production?
They've been incredibly disciplined. They've kept production low, with large ag production down 10%. They are laser-focused on one thing: reducing inventory.
And they're on track to hit that targeted $1 billion reduction in dealer inventory for 2025.
They are, which should normalize the channel. And they expect production hours to finally increase, moderately in 2026 as production gets closer to actual retail demand.
Despite these huge headwinds, they did have some genuine operational wins, right?
They did. They successfully reduced quality costs by over $60 million year to date. And the source material highlights that dealer feedback confirmed they achieved the highest delivered quality scores for large tractors in over a decade.
So that shows the efficiency and quality programs are actually working, even if the tariff drag is sort of obscuring the financial result.
For sure. Regionally, though, South America is still a headwind. Brazil, particularly.
Yeah.
Geopolitical issues, delayed farm subsidies, credit delinquencies.
Which forces CNH to increase risk reserves in their finance arm.
It does. Farmer sentiment there is just wait and see, especially with the uncertainty around global trade, like the announced U.S.-China soybean deal.
And what about that struggling construction segment? Any moves there?
Yes, as part of their manufacturing optimization, they finalized plans to stop production at their Burlington, Iowa plant by the second quarter of 2026.
And they're moving those operations to Wichita, Kansas.
Right. It's a clear, hardline move to streamline that underperforming segment and get rid of excess fixed costs.
So what does all this mean for you, the person watching CNH? If you only track a few things, these are the high priority factors that will really determine their success.
I think so.
First, if you only track one thing, track the global agricultural cycle. It is the most critical factor for near-term results.
Monitor farm income, commodity prices, trade flows. If soybean prices drop another 10%, you can bet that's going to tighten CNH's financials, and fast.
Second, keep a close eye on that precision agriculture technology adoption. Is CNH successfully integrating its acquired tech? Or are farmers still favoring Deere's proprietary system?
Because securing that high-margin recurring revenue is just vital for their long-term valuation.
You also have to track North American market performance. It is their single largest profit pool, and stabilizing their market share there is critical for margin stability.
Any continued steep decline in North American retail sales will just immediately translate to a weaker margin mix, no question.
And finally, monitor dealer inventory management. Are they going to meet that crucial $1 billion reduction target for 2025?
If they miss it, it signals continued weakness in retail demand, it delays the normalization of production, and it's going to pressure margins well into next year.
So to sum it all up,
CNH is strategically positioned as the solid global number 2 in agricultural machinery. They benefit immensely from scale and the stability of that captive finance arm.
and it's big, but this position comes with significant challenges. They face intense, technologically superior competition from Deere.
And elevated execution risk, particularly from the substantial drag from tariffs and the continual dilution of profitability from that underperforming construction business.
So here's a final thought. Given the massive difference in profitability and scale between their ag business and their construction business, will CNH ultimately stabilize construction as planned?
Or will the management team decide that focusing entirely on maximizing the high-margin, market-leading ag and financial services segments is the only way forward?
Perhaps through a strategic divestiture of construction. Is that the only way to truly challenge Deere's profitability advantage long-term? Something for you to mull over as you watch the market unfold.
A great question to end on.
Thank you for joining us for this deep dive. We'll talk to you next time. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.